let's shift now to the market. So we talked about the coronavirus being one type of when is this going to end. We talked about the economy and when is this going to end? When are we going to get back to normal unemployment levels? And then the third thing is the markets. The markets are their own sort of their own little monster, if you will. What we saw in Q1 was the Dow had its worst day since 1987 and also its best day since 1933. It was considered the worst quarter in our stock market's history, and we entered a bear market after the longest bull market in our history, and we entered it at such speed it was the fastest bull market in our country's history. And I have a little video I wanted to show you of Opie Taylor from Andy Griffith, and this is kind of, to me, how everyone kind of felt during the quarter, and hopefully you appreciate this. But this is what it kind of felt like. A punch to our gut. We came off of the market highs in February to experience the fastest bear market. So let's kind of revisit where we had been. We had the longest bull market, a 351% gain. And then in February 12th, we hit our peak. We didn't know it at the time. And within almost a month, we experienced a 20.3% bear market loss. And for further definition, this is what a bear market is. In case you've heard of the term, you don't really know what it means. You have a market high. It's followed by a correction, which is defined as a 10% loss from a recent peak. And then if it continues and falls 20%, that's when you officially enter into a bear market. So that's where we are right now. Once you've hit a bottom, the bull market is defined as when you get increased 20% more than the prior low. And we actually almost hit that this quarter, actually. There were some days where markets were skyrocketing so fast that people were speculating, saying we could be out of the bear market within this quarter. Now, it didn't happen, but here's the year-to-date numbers for the S&P 500. And as you can see, I've shown you going back to the 1980s, the different low points within every given year. They're marked by the red dots. And you'll see the gray bars are where the S&P 500 ended up at the end of the year. So you can see that during the year, there's a lot of intraday declines, and overall, hopefully you can see that overall markets are positive. But what we experienced was considered a black swan event, and you may have heard this phrase, but I'd like to explain it a little further after I take a little sip of water. A black swan event is a metaphor that describes an event that comes as a surprise, it has a major effect, and is often inappropriately rationalized after the fact with the benefit of hindsight. Nassim Taleb defined this black swan theory as highly disruptive events that can be downright life-altering. They're always impossible to predict. And the phrase comes from medieval England, where they used to say you'd rather or you'd sooner see a black swan than fill in the blank. It was similar to our expression, when pigs fly. The problem was, at the time in England, no one had seen a black swan. It wasn't until England purchased Australia, the discovery of Australia, where they saw their first black swan. And it threw out millennia of confirmation that there's no such thing as a black swan. And all of a sudden, in one day, they were completely wrong. So we see some examples of black swan in our recent history. 9/11 was a black swan event. The Beatles' rise to fame, that's considered a black swan. No one knew it at the time. No one would have predicted it. And then after the fact, we all say, well, of course, they're the best band out there. What about computers? Computers are another black swan event. Google and World War I and World War II. And typically wars in and of themselves are black swan events. After they happen, we all look back and say, well, yeah, we should have seen this coming. In fact, we did see it coming. But the truth is, you didn't. The unprecedented speed is shown here in this chart. In 2020, in 16 trading days, we hit the bear market. Only the Great Depression and the 1987 black market crash come close, and I've shown you those there. This bear market was 10 times faster than the average of 164 days. And when compared to the last 10 bear markets, they typically take about 1.5 years to achieve a 30% loss. Congratulations, we did it in 30 days. Bear markets take a while to recover too. As you can see here, the most infamous 1929 took 32.8 months to recover. The longest in 1937, and remember that was during World War II. World War II followed this, but that took 61.8 months. The shortest was in 1990, and it only took 2.9 months. Let's hope that that's the case for this one. The most recent in 2007 took 17 months, and on average, they take about 21 months to recover back to previous levels. However, there's also different kinds of bear markets, and as you can see here, there's structural, cyclical, and event-driven, and this is considered an event-driven bear market. It's an event because it has to do with the coronavirus and not something structural or cyclical. Remember, our economy was ticking off pretty well up until about February when headlines hit and everyone hunkered down and we entered this bear market. And you also see in this chart that bear markets recover, or event-driven bear markets recover the fastest. Will this be the case this time? I don't know. No one does. But hopefully this is an event-driven bear market, and hopefully it follows patterns that we've seen in the past. There's typically 4 stages of a bear market. First, there's the recognition phase, which says everyone kind of shrugs off a bear market's initial slide as being an ordinary event. Everyone says, okay, time to buy the dip. Buy the dip. When markets fall, great buying opportunity, until they realize this is not a normal correction. Then we enter the second phase of the bear market, which is called panic. The traditional advice of just buy the dip, it fails. Investors' faith is tested. We sell first, and then we ask questions later. And we saw that this quarter. The Dow dropped more than 34% from its peak, the fastest stock market decline since the Great Depression. We then see the third phase, which is stabilization. Stocks halt their decline, the panic subsides, but the situation still remains grim. We may be in this phase right now. We still might be in the panic phase, but I think we're in one of these panic or stabilization phases. Just like after an earthquake, we have aftershocks. We can expect aftershocks of market volatility. Investor sentiment in this third phase of stabilization, it varies between guarded optimism that the end is remotely in sight and despair that the hope was false. And this is typically the longest period of a bear market, is this stabilization phase. And finally, we get to the fourth stage of the bear market, which is anticipation, when stocks start their recovery. And they can recover extremely fast. As with a bear market's beginning, almost nobody recognizes the anticipation or the recovery of a stock market until after the fact. And so again, we cannot time markets, but there is opportunities within the market. Value is completely very, very cheap compared to growth right now. Value stocks are extremely cheap. I'm also seeing that stocks haven't looked this attractive since the 1950s when compared to the treasury yield. So this is comparing the S&P 500 dividend yield versus the treasury yield. And right now we're seeing really unprecedented attractiveness since the 1950s. I want to take a second and talk to you about how stock markets are leading indicators. Right here, I've got this nice little roller coaster chart here, and it starts by talking about the economic cycle. The economic cycle starts with a recovery. It leads into an expansion. We have a peak. We then have a recession. We have what's called a trough, and then we have a recovery. Now, let's layer on top of that the stock market. Well, the stock market, we have a bull market, and then we have a bear market, as I previously defined, and then the next bull market. As you notice, the bull market and the bear market precede the economic cycle. And this is why markets are considered to be leading indicators. In other words, the market anticipates a recession before the recession actually happens. So this is why when the economic unemployment numbers came out last week, the markets didn't move much. They didn't move much because they had already priced that in the previous weeks. You see, the market is a leading indicator, and at the same time, it also recovers before the actual economic recovery does. And it will spike up before we actually see the bottom and the trough of our current recession that's coming. The truth is, nobody knows where the top and bottom is. If we did, then we'd be billionaires, and I wouldn't be having this conversation with you. Nobody knows where that happens.